Welcome back to Talk Tickers. This is the show where we ignore the corporate gloss, cut through the PR spin, and get right down to the raw numbers of earnings season.
Exactly.
I'm your host, here to break down the balance sheets and figure out what is actually going on under the hood of the market's biggest movers. And I am joined, as always, by our resident expert.
It is good to be here. And today we have a really fascinating one. It's a classic case of good news is bad news, or maybe more like excellent execution in a really terrible neighborhood.
And that's the perfect way to put it. Today we are digging into IDEXX Laboratories, ticker IDEXX.
Right.
Their Q4 2025 earnings call was yesterday, February 2nd.
Right.
And if you're a pet owner, you know these guys. Even if you don't know, you know them. They do the blood work, the diagnostics, the software at your vet's office.
They are the backbone of the modern veterinary clinic. I mean, if your dog gets blood drawn or your cat needs a test, the odds are just overwhelming that IDEXX is processing that sample. They are the 800-pound gorilla in the room.
Right. And here's the hook for today's deep dive. IDEXX absolutely crushed expectations on paper. They beat on earnings, they beat on revenue, but the market took one look at the report and said, nope. The stock dropped 4.6% to close at $639.60. So we have a beat and raise quarter that leads to a big sell-off. What's the disconnect?
That disconnect tells you this is a battleground stock right now. The surface level numbers, the execution, margins, the tech were stellar. I mean, really impressive. But the macro environment, specifically the number of people walking their pets into a clinic, is flashing a bright yellow warning light.
The COVID pet boom bust.
Investors are terrified that it is fully busted, yeah.
Okay, so that's the mystery we're going to solve. We'll hit the headline numbers, unpack this visit volume scare, and then we have to look at their innovation pipeline. This lumps and bumps tech sounds fascinating.
It is.
And then, of course, we'll wrap with our not financial advice segment. So let's start with the report card. What did they actually deliver?
Okay, on the financials, it's a gold star. For Q4, GAAP earnings per share came in at $3.08.
And the street was expecting what?
The consensus was sitting around $2.93. So that is a solid, 5% surprise to the upside.
That's a significant beat. That's not a penny or two. So
yeah.
What about the top line? Are they selling more?
They are. Revenue hit $1.091 billion. That's up 14% reported and 12% organic. And I want to pause there. Double-digit organic growth right now.
That's tough to find.
It is incredibly hard to find. Most companies are scraping by with low single digits, or they're just growing through price hikes. IDEXX is actually moving volume.
And it seems like you're getting more profitable doing it. This isn't just growth at all costs.
Correct. This is the efficiency story. Gross margins expanded to 60.3%, up 50 basis points. But the real heavy lifting was the operating margin. That hit 28.9%.
Wow.
That is a massive 150 basis point jump year over year. They are squeezing more profit out of every single dollar.
And they gave guidance for 2026 as well.
They did. They're guiding for 2026 revenue between $4.63 and $4.72 billion, with EPS landing somewhere between $14.29 and $14.80.
Which is a raise versus what people were modeling.
It is.
So let's just recap. High growth, expanding margins, beating estimates, raising guidance. Wall Street calls this a beat and raise. Stocks usually pop on this news.
The holy grail of earnings calls.
So let's get to it. The elephant in the room. Why did the stock shed almost 5%?
It all comes down to one metric. The one number you can't really engineer with buybacks or cost cuts. It's clinical visit volume.
Foot traffic.
Exactly. Investors are looking right past the Q4 beat, and they're obsessing over the fact that fewer people are actually going to the vet.
And what were the numbers there?
In the U.S., same-store clinical visits declined 1.7% in Q4. For the full year of 2025, they were down 1.9%.
That feels like a trend, not a blip.
It is a trend. And the kicker, the thing that really soured the mood, was the 2026 assumption. Management explicitly said they baked a roughly 2% decline in U.S. visits into their guidance for next year.
Why does that matter so much?
Yeah.
I mean, if they're making more money anyway, who cares?
Because the market hates seeing a negative assumption in a core driver. It suggests the bottom isn't in yet. If management, who has the best data in the world, thinks fewer people are coming, why should an investor bet on growth? It implies the pie is shrinking.
Okay, so let's drill down. Is it just the economy? Why are people not going to the vet?
It's nuanced, and this is where it gets interesting. It's really a tale of two visits. You have wellness visits and you have sick visits.
Okay.
Wellness, your routine checkups, puppy shots, annual make sure everything's okay trip. Those were down 3.6% in Q4.
That screams inflation.
Yeah.
If money's tight, rent is up, Groceries are up and the dog seems fine. You skip the checkup to save $200.
Precisely, it's discretionary. But sick visits, non-wellness, were much more resilient. If the dog is limping or, not eating, people still pay. They show up.
So the need to have is stable, but the nice to have is dropping off.
Exactly. But there was one very specific bright spot in the data that I think is critical for the future of this stock. Visits for pets aged 5 years and older are actually improving.
The pandemic puppies?
The pandemic puppies are getting gray muzzles. That huge cohort of dogs from 2020 and 2021 is now entering the age where health issues start cropping up.
So fewer new puppies are coming in for shots, but the older dogs are needing more medical care.
You got it. We're moving from a puppy boom economy to a geriatric care economy for pets, and geriatric care is more expensive.
But the fear is still there. Can IDEXX keep growing revenue 12% if the number of dogs walking through the door keeps dropping 2% every year?
That is the bear case in a nutshell. You can't fight gravity forever.
Okay, but they did do it this quarter. So how are they defying gravity right now? What's the trick?
This brings us to their whole strategy, which is revenue per visit. If you have fewer patients, you have to extract more value from the ones who do show up. And they do this with high-tech diagnostics.
And the star of the show seems to be this inVue DIX system. What is this thing?
So, inVue DIX is a cellular pathology platform. Think of it like a microscope with a brain. Traditionally, if a vet finds a strange lump, they take a sample, mail it to a lab, and wait 3 to 5 days.
Agonizing for the owner.
Totally. It's agonizing and inefficient. The inVue DIX lets the vet prepare a slide right there, put it in the machine, and get results in minutes.
Instant gratification and instant billing.
And instant revenue. They placed 1,900 of these units in Q4 alone. They have nearly 6,400 out in the wild now. It's a rapid rollout.
And what's the killer app for it?
They're launching a feature for what's called fine needle aspirate analysis, specifically targeting mast cell tumors.
Why mast cell tumors?
They are very common skin cancers in dogs. They can look like nothing or they can be deadly. With this tech, a vet can poke it, test it, and know before the client leaves if it's cancer or just a fatty lump. It turns a wait and see into a treat it now procedure.
So the strategy is, the dog is already here, let's do more comprehensive testing right now.
Exactly. Even if visits are down 2%, if you can increase the bill 15% with better diagnostics, you still grow. And that brings us to cancer, their other major growth lever.
This is the blood test, right? Not a biopsy.
Yeah, liquid biopsy. They can detect cancer markers in a simple blood draw, but the real wow factor is the lymphoma marker. They share data that they can detect lymphoma signals in the blood up to 8 months before any clinical signs appear.
8 months? That's incredible. Why is that so important?
Because by the time a dog shows signs of lymphoma, the cancer is advanced. If you can catch it 8 months early, you have entirely different and better treatment options.
And financially, it opens up a huge preventative market.
Management sees a $1.1 billion long-term opportunity just in these panels.
So they're betting that even in a recession, people will pay to screen for cancer before their dog even seems sick.
And history suggests they will. The emotional bond, especially with those aging pandemic dogs, is incredibly inelastic. You'll skip a vacation, but you won't skip a cancer screen for a family member.
There was one other piece of tech that caught my eye, and it was about the humans. The ImageVue DR50 Plus.
Ah, yes, the new digital X-ray system.
They made a big deal about the low radiation dose. Why is that such a selling point?
This is a fascinating insight into the vet workforce. Roughly 75% of veterinary technicians, the people holding the dog for the X-ray, are women of childbearing age. Radiation safety is a massive workplace concern.
Oh, wow. I hadn't connected those dots.
If you own a clinic, your biggest headache isn't pets, it's staff retention. Turnover is high. By offering the lowest dose system, IDEXX isn't just selling a better picture, they're selling staff safety.
That's smart. It solves a business problem for the vet. Okay, let's go back to financials. What about the recurring revenue, the razor and blade model?
The engine is humming. The CAG Diagnostics recurring revenue, that's the consumables, the tests, was up 10% reported globally. But there's a shift happening in how they get that growth.
Pricing.
It is. In 2024 and 2025, they leaned hard on price increases. In Q4, they realized about 4% from price. But for 2026, they are tapping the brakes.
What's the new plan?
Only about 3.5% price realization in the U.S. They're choosing volume stability over aggressive hikes. They know the consumer is fragile. If they push price too hard, they might crush that visit volume even more.
Seems smart. You can only raise prices so many times before people just stop showing up.
Exactly. And they're offsetting that with efficiency. Remember those margins? They expanded operating margins by 150 basis points while still hiring commercial teams in Germany, the UK, and Australia.
Wait, hiring? Right now, in a downturn?
Aggressively. They are actually reducing the number of accounts each sales rep handles.
Why would they do that? That sounds inefficient.
It's the opposite. It's a high-touch strategy. If a rep has fewer clinics, they can spend more time at each one, teaching the staff how to use the new cancer test. If the staff knows how to use it, they'll sell it. It's an investment in utilization.
Ah, so they're spending money to make sure the expensive machines actually make money.
You got it. They are playing offense while others might be pulling back.
And what about the software? The Velo app?
Velo is the sticky factor. The user base grew 40%. The data shows clinics using Velo have fewer no-shows and higher compliance. If the app reminds you to book the follow-up, you do it.
It's digital glue.
It is. Once a clinic has everything running on IDEXX software, switching to a competitor is a nightmare. It creates a moat.
So bringing it all back to investor sentiment. Great execution, amazing tech, but a stock in the penalty box over foot traffic. What's the vibe check?
The vibe is definitely neutral to cautious.
Give me the bull case first. If I'm buying today, what am I betting on?
The bull case is that execution is flawless. The innovation flywheel is working perfectly. They placed over 6,500 premium instruments in Q4, up 42% year over year. That's a massive base for future revenue. The bull says the macro will turn eventually, and this company is a coiled spring.
A Ferrari stuck in traffic.
Perfect analogy. And the bear case.
The bear case is just that the traffic isn't clearing. If visit volumes go from -1.7% to -3% or -4%, the math stops working. You can't upsell a client who isn't there. If sick visits start to drop, the stock is further to fall.
The road is closed, not just congested.
So the stock is just in a holding pattern until we see if that traffic comes back.
Correct. It's a show-me story on volume. The market needs proof that the decline has bottomed out.
All right, that brings us to my favorite part of the show. We've looked at the data, heard the analysis. Now we throw caution to the wind.
There we go.
It is time for our not financial advice segment. Remember, listener, this is for entertainment only. Do not do this. It's satire, speculation. But if you were pitching a wild idea based on this call, what is it?
I call this trade the silver muzzle arbitrage.
I love it already. Lay it out for me.
The thesis is simple. We are betting against puppies and for geriatric dogs.
Okay, explain. Why are we hating on puppies?
Well, look at the data. Wellness visits, puppy shots are tanking. The COVID puppy boom is over. We're in a puppy recession. But visits for dogs 5 and older are growing. That huge cohort of pandemic dogs is entering their expensive medical years.
So how do we trade it? What's the law?
The long is easy. You go long IDEXX, ticker IDEXX. They own the sick dog and cancer screening market. Old dogs get lumps. Old dogs get lymphoma. Owners of old dogs will pay anything to keep Fido going. You're betting on guilt and love.
And the short side. Who gets hurt by the puppy recession?
You short the consumer discretionary pet plays, the companies selling puppy pads, chew toys, new crates. If adoption numbers are crashing, nobody is buying a new crate. Nobody is buying teething rings. But the 8-year-old lab still needs a $300 blood panel.
That is dark, pragmatic, and honestly pretty compelling. You're hedging against the recession by betting on the emotional inability of owners to say no.
Exactly. It's the geriatric dog medical boom versus the puppy retail bust.
I'm calling it the lumpy dog long.
The lumpy dog long. That's the one.
All right, let's wrap this up. Recap the main takeaway for us.
IDEXX delivered a beat and raise in a very tough neighborhood. Their financials are bulletproof, great margins, great cash flow. But the macro environment, specifically that declining foot traffic, is just an anchor around their neck. They're doing everything right, but they are swimming upstream.
And here's a final thought for you to chew on, listeners. We're all worried about what happens if visits keep dropping. But IDEXX just proved they can grow earnings double digits while fewer people go to the vet. What happens to this stock the moment the economy turns and visit volumes actually go positive?
That is the upside risk the bears might be ignoring.
If they're this efficient now, they might be a rocket ship when the tide turns.
Yeah.
Something to think about. That's it for this edition of Talk Tickers.
See you next time.
Thanks for tuning in. Make sure you hit that subscribe button so you don't miss our next deep dive. We'll see you then.